Hi, I'm Midas, and in today's video, we're going to be taking a look at some of my favorite investing books. Today's video is a continuation of a video I did a couple weeks ago on the 3 best books for beginner investors. So if you haven't checked that out, you might want to check that out before watching this one. But if you don't consider yourself a beginner investor, instead you want to find out what some of my favorites are, whether they're for beginners or not, then stick around and you'll hear about my top 5. But before we get into that, please like the video and subscribe to the channel to get notifications about my live streams that we do every week, and perhaps to join the Discord. You can find the link in the description below to have discussions with other like-minded individuals in our community. Now, the first book we're going to get in today is Common Stocks and Uncommon Profits by Philip Fisher. Philip Fisher was a pioneer of what he called the scuttlebutt method, which had to do with researching a company by looking into its employers, as well as its stockers and its customers, as well as any other outside or third party that it might have to interact with, by going around and asking questions of these groups, seeing what it is and what it's like to deal with a company on all of these business to business relation activities, and getting an idea of the quality of the business by these relations. He was also a bit of a pioneer in the world of growth investing, putting a pretty huge amount of significance on the research and development done by a company, and especially the research and development and how it leads to internally developed products. He was very big on stressing the importance of management, but not just management, but also the quality of lower level personnel and lower level management. And he wasn't very big on diversification or selling, and was known to carry stocks for many decades, and basically to his grave. The second book we're going to cover today is Narrative in Numbers by Aswath Damodaran. I'm a big fan of basically everything written by Damodaran, but that one's one of my favorites. The book is especially important at tying together different aspects of investing, that being the number crunching side and the more creative storytelling side. He puts a pretty significant amount of focus in the book on numbers and data and how to interpret them, analyzing the difference between precision and accuracy, highlighting as well the large amount of biases that exist around us in everyday activities and how we can't avoid it, instead about how recognizing these biases can help us become better investors. He talks a lot about interpreting statistics, but also talks about different tools about making use of all the statistical information around us. And he uses all these things to help tie numbers to a story by showing that you can focus on a few key metrics, that being, in his case, growth, profitability, investment, and risk, as a way to make a pretty simple story when trying to share your valuations with other people. He also focuses on the different types of stories that investors can tell, between the possible, the probable, and the plausible, and then focuses on different ways stories that can become impossible, whether it becomes a story of somebody growing bigger than the economy in which they operate, or having larger than 100% profits, or having capital that comes at no cost. And biggest of all, he talks about what's known as the big market delusion, which is the idea that many players can all become winners in a space if the market itself is large enough, and how this can delude investors into dangerous investments. The third book I'm going to cover today is The Tao of Capital by Mark Spitznagel. This is a very interesting book, and honestly, there's just so much into it that I'm in that book that I don't even really know where to begin in such a short, brief explanation. I like it partially because it's a little bit of a blend of my favorite schools of investing, that being something close and akin to value investing, and mixing it with some of my favorite schools of economics, that being the Austrian School of Economics. Mark Spitznagel cut his teeth as a Chicago board trader, so he's very familiar with a little bit more of the underpinning workings of the market than the average person. Talks a lot in the earlier parts of the book about his mentor, Everett Klipp, and the paradox that Klipp taught him about how the key to making money is learning to love to lose money, as it's quoted there. He talks a lot about a lot of interesting philosophical concepts relating to Chinese philosophy, German military history, as well as even the history of the conifer trees, and how these different things can all relate to investing. Might sound strange in such a brief explanation, but like I said, there's just so much in the book that I can't even begin to explain it. He also talks a lot about the Great Depression, and one of the main key icons of the Austrian School of Economics, who was an investor who managed to slide past it, that being Ludwig von Mises. And then the later parts of the book, he outlines 2 Austrian economics related methods of investing that he discusses, being Austrian investing 1 and 2, one of which being essentially an understanding of overvaluations of the market and using tail hedging to protect yourself, and the second version being akin to a price stacking or valuation based methodology, somewhat similar to the magic formula by Joel Greenblatt. In fact, he even recognizes Joel Greenblatt by name in the book. Now, the fourth book I'm going to discuss here today, I don't actually have a normal copy of the book. It's actually The Margin of Safety by Seth Klarman. It's become a little bit of a cult classic in investing circles as an informal sequel to The Intelligent Investor by Benjamin Graham, which with copies of this book only coming from one original printing. And if you want to buy copies of it, it costs several thousands of dollars, usually on eBay. You can find PDFs of it online. And the author himself has said that he doesn't mind people downloading them. And as you see, I kind of printed off my own copy right there. The book, as it is lauded to be, is effectively a sequel to Ben Graham's famous and historic tome, kind of putting it in a little bit of a more modern light, covering a lot of the same topics, though he does cover a few things a little bit differently, and also covers different examples of those same topics. It discusses a lot about more modern aspects of the investing world, having to do with diversification theory and about how we can diversify riskier things into making them less risky, and gives the example of the junk bond craze during the 1980s, and gives a lot of criticisms of that idea. He talks a lot about focusing on absolute returns and stresses that how value investing is a bottom-up approach, and that you can't think about things from a top-down level on an economic wide level or macro level and actually be successful as a value investor. He talks a lot about how by its very nature value investing is contrarian, and so you kind of have to be prepared for that, and that's one of the reasons why it's successful in the first place, is that it requires a contrarian nature, and that's one of the reasons that even though people know it works, it can't actually go away. And he also talks about a lot of the ways that these contrarian nature to investing creates inefficiencies because of the way that people's natural psychologies, as well as the structures of the markets and Wall Street itself, are built in such a way that it creates inefficiencies, and those inefficiencies can be exploited by the enterprising value investor. Now, the last book we're going to discuss today isn't actually a book per se. It's actually a series of letters written by Warren Buffett himself to his partnership shareholders during the late 50s and into the late 60s. You can find these also online, available in lots of different sources in PDF form. There is no actual book form of this to necessarily purchase, unlike The Margin of Safety, which at least has the one original printing of it. Like I said, this isn't actually a book, but this is one of the best sources, I think, on trying to understand one of the best investors in his prime. And in his prime is definitely of note. It's worth specifically noting that the Buffett that you can read about in these shareholder letters is so completely different from the Buffett of the last couple of decades in terms of the level of back and forth types of actions he's willing to move in trades, the type of levels of controls he's willing to type of approach, and the type of returns he's aggressively attempting to get. And you can also argue that has to do with the scale he was at that time. Part of the interest of these letters doesn't necessarily have to do with a lot of the specific details that you can learn, unlike the other books. It has more to do with just trying to absorb the history and the knowledge and the experience that he's going through itself. Not to say he doesn't give his little lessons in history and compounding with several of the letters talking about the history of economic growth in the United States at various points. He does talk about the market as a whole compared to himself, even though he doesn't depend on the market for explanations about why he got the returns he did. It is worth noting that he outperforms every single year during this series, which is just fantastic and crazy to see. Not only does he have such an intensely high compound return above 25%, but the fact that he literally outperformed the market every single one of those years, not just over the long run, is just something crazy to behold. He also talks a lot about the different classifications of investment types that he works through, private and relative valuations, as well as workouts and controls being the four main categories. And then I think it's especially worth noting just how much he focuses on his competition, that being the major mutual funds that operated during this time frame and the average returns that people could have gotten by investing in them compared to him. Spoiler alert, he massively outperformed all of them as well as the market, because obviously they generally had difficulty keeping up with the market. And then at the end of this series of letters, as he's ending his partnership, I think it's remarkable to note just how much care he has in passing his partners on to the various other alternative places that they're going to seek their investments after the partnership had closed. If you enjoyed the content, please like the video and subscribe to the channel and hit the bell to get notified whenever we go live to do valuations on stream. Also, if you want to join our Discord, you can find the link to that down below in the description, where you can join and have live discussions with me or some of the other investors in our community about the various companies that we cover.